Today, 20,000 and counting. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. And first tonight, I just want to say thank you to all of those who've subscribed to the DFA channel, because we've now reached more than 20,000 subscribers. That's pretty remarkable, really, given that about a year ago, we were sitting close to 5,000. So I want to say thanks to all of you who've written in, who've watched the shows, who've participated in the online chats, and all of those who have been sharing our posts with other people via social media. We've got, of course, plans to take the DFA channel further and to hopefully increase the subscriber base as well. But it's important to say that we're going to hold true to our core values, which are independent, objective, and data-driven analysis of what's going on in finance and property in Australia and New Zealand and around the world. Now, in that vein, data came out today from ANZ that said the weak Q1 GDP and the soft retail figure for April have seen consumer confidence move lower over the past week, despite the rate cut from the RBA. And looking back to the rate cuts in 2015 and 2016, there was no tendency for confidence to rise immediately following the move lower in rates. So it's not particularly surprising that there has been no immediate boost from the rate cut. Inflation expectations readings below 4% seem to have become the norm in the past couple of months, which is unique in the history of their survey, and something the RBA will be taking note of. And the Westpac Consumer Sentiment Survey was weak as well, especially after the rate cut announcement. They say that this is a disappointing result given the cut in official interest rates this month, and suggest deepening concerns about the economy have outweighed the initial boost from lower rates. Indeed, the Reserve Bank's move was widely anticipated and may well have franked those concerns, which would have solidified further following the disappointing national accounts figures released a day later. The March quarter GDP update showed growth slowing to just 1.8% at the start of the year, and that's the slowest pace since the GFC in 2009, and a full percentage point well below trend of 2.75%. And moves in the component indices supports this interpretation. The biggest decline was in the sub-index tracking expectations for the economy over the next 12 months, which dropped 4.7% to be back in slightly pessimistic territory. In contrast, the finance next 12 months sub-index caught a decent 3.1% rise. That was despite the finance versus a year ago sub-index weakening 2.4%. And the mix implying that household finances remain under pressure, but are expected to improve as lower interest rates and income tax relief comes through. Interestingly, the sub-index tracking longer-term expectations for the economy showed a very slight improvement, 1% higher. And attitudes towards spending were largely unchanged, with the time to buy a major household item sub-index dipping 0.2% to 115.5. And the index has been stuck in a tight range well below the long-run average of 127. With readings on current finances also weak, this suggests consumer spending is likely to remain weak near term. And responses over the survey week showed a marked drop-off after the Reserve Bank's official rate cut. Responses collected before the June 4 decision had a combined index read of 106.8, and those collected after had a combined read of 95.5, with daily results showing a further softening after the weak GDP report. The subgroup detail points to several factors affecting consumer segments. The surprise federal election result on the May 18 produced a strong rise in sentiment among coalition voters, up 7.5% in the month, but an even sharper decline among ALP voters, down 9.9%. The associated change in outlook for tax policy around investment housing also produced a strong lift in sentiment amongst consumers, with an investment property up 9.5% and likely contributed to a fall in sentiment amongst renters, down 5.3%. In contrast, sentiment amongst the mortgage belt showed a 2.8% rise, the gain reflecting the cut in interest rates, but a more muted response than in previous cuts, where sentiments had surged 7% and 15% following the previous cuts in 2016. Responses to additional questions on news recall provided some additional pointers to the factors influencing sentiment. The highest recall was for news on economic conditions at 31%, interest rates at 29%, and budget and tax at 20%. Notably, news around all three topics was assessed as less negative than in March, the last time these questions were run in the survey. There was a particularly sharp turnaround in budget and tax news, which was viewed as deeply negative in March, but a slight positive in June. The personal income tax cuts announced in the April budget and the federal election result likely contributors. It should be noted that while consumer sentiment has dipped in this last month, it is still 1.9% above its March level. And consumer confidence in the labour market faltered again in June. The Westpac Melbourne Institute Underemployment Expectation Index recorded a 5.1% rise, reversing all of the previous month's decline. And recall that higher readings indicate that more consumers expect unemployment to rise in the year ahead. Expectations have been volatile in 2019, suggesting labour market conditions may be shifting. New South Wales and Victoria showed particularly sharp rises in June, both up 7.9%. That said, the index levels in these states and nationally are still slightly better than average. Housing-related sentiment showed a clear response to the lowering in interest rates, although again, some of the gains were more muted than seen in past rate cuts. In particular, the time to buy a dwelling index posted a 1.8% rise to 116.9, a rise but a subdued one compared to the plus 10% gains recorded following the previous cuts in 2016. And some of this likely reflects the mixed effects from the federal election and the rate moves on views across different subgroups. Assessments among consumers with an investment property surged 8.5%, but assessments among renters dropped 8.7%. Where policy changes have generated by far the biggest shift is around expectations for house prices. The Westpac Melbourne Institute Index of House Price Expectations Index posted a spectacular 22.7% gain in June, moving from deep negative territory of 89.4 to a clear positive read of 109.7. And this is the highest level since August 2018, but still well below the long-run average of 126. All states recorded sharp rises and net positive reads over the 100 mark, and overall the mix suggests consumers see policy shift as a clear positive for the price outlook, but a much more mixed result for buyers in terms of affordability. Responses to additional questions on the wisest place for savings showed a slight easing in risk aversion, although it remains very high by historical standards. And consumers still heavily favour safe options, with 64% nominating deposits, superannuation, or paying down debt as the best place for savings. The proportion favouring real estate nudged up, but only slightly, from 9% to 10%, still near historic lows. And likewise, the proportion favouring shares lifted from 7% to 10%. Despite the slight shift, the mix still points to risks that households increase savings rates further in the months ahead. And so Westpac concluded that the Reserve Bank next meets on July the 2nd. The initial sentiment reaction to the June rate cut will be somewhat disappointing for the bank. It comes after a disappointing March quarter national accounts update that means the bank will need to make a further downgrade to its growth forecasts. The case for further policy easing remains clear, and they continue to expect a further 25 basis point cut to be delivered in August, the timing allowing the bank to make a fuller assessment of the impact of its initial move and to provide a complete set of updated forecasts with its August statement on monetary policy. The labour market will remain a key focus for the policy profile. And Westpac's more downbeat view on this front points to a further 25 basis point cut in November, taking the cash rate to, wait for it, 0.75%. So if you compare Westpac's report today with my own data yesterday, there are some similarities. There was a spike in property investors' confidence levels, but overall, households are still pretty risk averse and are unlikely to start spending soon. My conclusion, as I stated yesterday, is there is little here to suggest that home prices are going to start taking off anytime soon. And I think we're going to be in for a long grind. And I think more rate cuts will indeed be on the cards later in the year. But of course, rate cuts don't necessarily translate into significant momentum in the housing sector. And that's the bottom line, really, because the RBA is clearly expecting that to occur. If it doesn't, then they will be forced to move into quantitative easing and even negative interest rates. So once again, more evidence today of the uncertainty facing us. And by the way, let me just say, as a few people have asked, why am I so negative? Well, the reason I'm so negative is not because I only fixate on the negative, but the data is pretty that way inclined at the moment. If more positive news comes through, rest assured, you'll hear it here first. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.